Okay, let's dive right in. We're going to put a real tech titan under the microscope today, Broadcom. I mean, this company is an absolute powerhouse, right at the center of the whole AI revolution. They make the critical gear that powers, well, pretty much our entire digital world. So on paper, you'd think, wow, this is a perfect investment. But here's the kicker. Would a guy like Warren Buffett, the world's most famous value investor, actually pull the trigger on it? I think the answer is going to surprise you.
And yeah, that's the big mystery we're really trying to solve here. You've got Broadcom, this incredible cash generating machine that's completely essential to the AI boom, and yet the way they operate is almost the exact opposite of what Warren Buffett looks for in a company. So what gives? What's the disconnect? Let's figure it out.
All right, first things first, we've got to build the case for Broadcom. Because, to really get why Buffett would probably take a pass, you have to understand just how insanely powerful this company is. It's got this incredible defense system that investors call a moat, and believe me, it is almost impossible for competitors to get across. So, picture the AI boom like one of those old school gold rushes. You've got companies like NVIDIA out there, selling the dream of finding gold. But Broadcom, they're doing something smarter. They're selling the picks and the shovels. They make the super high-end networking chips that are the backbone of AI data centers. Seriously, you just can't have this AI revolution without their gear. So, how does this moat actually work? Well, it breaks down into three pretty simple but powerful parts. First up, massive switching costs. Once a customer designs their whole system around Broadcom's chips, it is a huge, expensive nightmare to switch to something else. They're basically locked in. Then you've got this fortress of patents and intellectual property protecting them. And finally, number three, they've basically got a near monopoly on some of these super critical networking chips. You put all that together, and boom, you've got incredible pricing power.
And here's the proof in the pudding. This chart just says it all. Take a look at the free cash flow. That's the real hard cash left over for shareholders after everything's paid for. It is just exploding. I mean, from about $12 billion to almost $20 billion in just 4 years. That is the hallmark of a truly elite business. Everything's looking pretty great so far, right? Well, hold on. Here's where the plot twist comes in. The way Broadcom got this incredible growth, well, it shows a huge fundamental difference between their strategy and Buffett's playbook. And it all boils down to one simple four-letter word: debt. Check this out. It's like two completely different worlds. On one side, you've got Broadcom CEO Hock Tan, and his playbook is honestly brilliant in its own way. He goes out, buys these huge established tech companies using a ton of borrowed money, and then he just aggressively slashes costs to squeeze every last drop of cash out of them. And then you've got Warren Buffett. His whole thing is buying simple, wonderful businesses that grow patiently, organically, with almost no debt. We're talking about two totally different philosophies for creating value. And look, this isn't just some theory. This is what Broadcom actually does. They've gone on this massive shopping spree, buying up giants like CA Technologies, the enterprise part of Symantec, and of course that monster $60+ billion deal for VMware. This isn't your slow and steady organic growth. Nope, this is growth by conquest. So here's the catch, the crucial point. Remember all that amazing cash flow we were just looking at? Well, it comes at a price. The company's debt-to-equity ratio is a staggering 87.6%. Now, sure, they make enough cash to manage that debt, but that amount of leverage, that is a massive red flag for a super conservative investor like Buffett. He's famous for saying he wants to own businesses that let him sleep soundly at night. This might keep him up. Okay, so let's recap. We've got a fantastic business, no doubt, but it's powered by a risky, debt-heavy strategy. So, for any value investor, there's one last critical piece to this puzzle: the price. Is the stock actually cheap enough to make up for all that risk? Let's dig into the numbers and see. Right off the bat, the first warning sign jumps out: the price-to-earnings ratio, the good old PE ratio. It's just a simple way to see how expensive a stock is compared to its profits. And based on the standard accounting rules, the GAAP numbers, Broadcom's PE is over 100. Now I know analysts will use adjusted numbers to make it look a lot lower, but for a traditionalist like Buffett, a triple-digit PE is like a giant flashing red stop sign. And this all leads us to the absolute bedrock of Buffett's entire investment philosophy, what he calls the margin of safety. The idea is actually super simple. You don't just find a great company, you have to buy it for way, way less than you think it's actually worth. That discount, that's your protection. It's what saves you if you made a mistake in your calculations, or if the whole market just decides to take a nosedive. So let's put it all together. Here's the final verdict, in plain numbers. If you crunch the numbers on its future cash flows, a pretty fair estimate for Broadcom's intrinsic value, what the business is really truly worth, is somewhere around $425 a share. But the stock is trading at around $403. So that discount, your margin of safety, is only about 5%. For someone like Buffett, who's looking for a discount of 20%, maybe even more, that is just nowhere near cheap enough to take on all the risks we've talked about. So where does that leave us? What's the final call? Well, when you have a business model that is this complex, that relies so heavily on giant acquisitions and tons of debt, it lands squarely in a pile that Buffett famously calls his too hard pile. And really, that's the main takeaway here. Broadcom is, without a single doubt, a financially wonderful company. It's an incredible operator in a super important industry. But, and this is the big but, for a true value investor, a wonderful company selling at a merely fair price just isn't a good investment. It's not enough. You need a real bargain. And I think this quote from the analysis just nails it. Broadcom is a masterful operator, but an aggressive capital allocating machine, not a serene, organically growing compounder. It's a perfectly run machine, for sure, but it's an aggressive, complex one built for conquest. It's just not that calm, predictable, steadily growing kind of business that makes up the bedrock of the whole Berkshire Hathaway empire. And that one fundamental difference, that's why this AI superstar ultimately fails the Buffett check.